In 1179, the Catholic Church declared that anyone who charged interest on a loan would be excommunicated, banned from receiving sacraments, and denied Christian burial. The message was absolute. Lending money at interest, called usury, was a mortal sin. According to church teaching, if you died as a usurer, you would be condemned to hell. No exceptions, no mercy. Yet by 1300, the richest institution in Europe was the Catholic Church. The banking families who operated under church protection in church cities with church blessing. The Medici family in Florence, the Fuggers in Germany, the Lombard bankers across Europe. All of them charging interest. All of them financing the same church that condemned usury as sin. Here's the contradiction that built modern finance. The church needed banking to function. Pilgrims needed to move money. Crusades needed funding. Monasteries needed to invest donations. Popes needed credit. But admitting they needed interest-based lending would undermine centuries of theological doctrine, so they didn't admit it. They invented workarounds, legal fictions, financial instruments that looked like charity but functioned like loans. Welcome to the Financial Detective, where we investigate financial systems like crime scenes, because money, power, and history collide, and someone always profits. This is case file number 4, the holy money launderers. How the Catholic Church condemned usury while simultaneously inventing banking. And by the end of this investigation, you'll understand exactly how religious institutions created the financial tools that built capitalism, why the word bank comes from an Italian bench, and how every institution bends its own rules when survival. Let's start with the theological problem. Christianity inherited a prohibition on usury from Judaism and early church teachings. The Bible was explicit. Deuteronomy 23:19. You shall not charge interest to your brother. Exodus 22:25. If you lend money to any of my people, you shall not be to him as a creditor. The early church fathers, Augustine, Aquinas, and others, reinforced this. Lending at interest was exploitation. It was profiting from someone else's misfortune. It was unchristian. This wasn't just doctrine, it was enforced. Church councils repeatedly condemned usury. In 1139, the Second Lateran Council declared usurers infamous persons. In 1311, the Council of Vienne declared that anyone who claimed usury wasn't a sin was a heretic. The punishment extended beyond life. Usurers couldn't receive sacraments. They couldn't be buried in consecrated ground. Their wills were invalid. Their estates could be confiscated. And after death, according to church teaching, they faced eternal damnation. Hell wasn't metaphorical. It was the explicit consequence. But here's the economic reality. Medieval Europe needed credit. Farmers needed loans to buy seed. Merchants needed capital to fund trade voyages. Nobles needed cash to equip armies. Cities needed financing for construction. Without credit, the economy couldn't function. Real credit requires interest, because lending money has costs. Risk of default, opportunity cost. Inflation over time. Without compensation, no one lends. So medieval Europe faced an impossible contradiction. The church said lending at interest was sin. The economy required lending at interest to survive. It just got reinterpreted creatively. This is where the crime scene begins. Because what happened next wasn't reform. It wasn't the church saying we were wrong about usury. It was something more sophisticated. The church maintained the prohibition publicly while creating legal mechanisms privately to make lending possible. They condemned usury in sermons while practicing banking in monasteries. They punished Jewish moneylenders for doing exactly what Italian Christian bankers did under different names. The contradiction wasn't a mistake. It was the system. So how do you build a banking system while maintaining that lending at interest is a sin? You get creative, very creative. The first workaround was linguistic. Don't call it interest, call it something else. A gift, a penalty for late payment, a partnership share. The scholastic theologians, the church's intellectual class, developed elaborate justifications. If a lender suffered a loss by not having his money available, he could charge for that loss. This was called damnation, harm incurred. If a lender missed out on profit he could have made with that money, he could charge for that lost opportunity. This was called lucrum caesans, profit ceasing. These weren't interest, officially. They were compensation for harm and lost profit, which meant they weren't usury, which meant they weren't sin. The logic was circular, but it worked, because the church said it worked. The second workaround was the bill of exchange. This was genius. Here's how it functioned. A merchant in Venice wants to send money to a partner in London. He goes to a banker, hands over 100 florins, and receives a bill, a written promise that his partner can redeem in London for an equivalent amount in English pounds. The exchange rate is set in advance. The banker makes money on the currency conversion, not interest, exchange fees. Except the exchange rate was always favorable to the banker, and if you converted the money back to florins later, you paid another exchange fee. And if you waited longer to convert, the rate was even better for the banker. In practice, this was a loan with interest. But because it involved currency exchange, it wasn't technically usury. Bills of exchange became the foundation of medieval international banking. They allowed capital to move across Europe without physically transporting gold or silver. They financed trade. They funded wars. And they generated enormous profits for bankers, all while technically complying with church law. The third workaround was partnership. Instead of lending money at interest, a banker would invest in a merchant's venture. They became partners. The banker provided capital. The merchant did the work. They split the profits. This wasn't a loan. It was a business arrangement, perfectly legal under church doctrine. Except the terms were always structured to guarantee the banker a return. The merchant bore all the risk. If the venture failed, the merchant owed the full amount. If it succeeded, the banker took the larger share. It was a loan in everything but name. But because it was framed as partnership, it avoided the usury prohibition. The fourth workaround was pawnbroking. If you needed cash, you brought something valuable, a piece of jewelry, a tool, land title, and left it as collateral. The lender gave you money. When you repaid, you got your collateral back. No interest charged. Technically, the amount lent was always far less than the collateral's value. If you brought a gold ring worth 10 florins, you might get 3 florins. When you repaid, you paid back 3 florins, but if you couldn't pay, the lender kept the ring worth 10. The difference was profit, not interest. So, profit from asset seizure. And if you did repay, there were storage fees, administrative fees, appraisal fees. By the time you paid all the fees, you paid significantly more than you borrowed. But it wasn't called interest, so it wasn't usury. The fifth workaround, and this is where it gets dark, was outsourcing. Christian law forbade Christians from lending at interest, but it didn't forbid Christians from borrowing at interest from non-Christians. So Jewish communities across Europe became moneylenders, not by choice, by necessity. Most professions were closed to Jews. Land ownership was restricted. Guild membership was forbidden. But moneylending was permitted because Christians needed credit and couldn't provide it themselves. Jewish moneylenders charged interest openly. They faced no theological prohibition, but they paid a price. They were resented, persecuted, and periodically expelled. When debts became too large, it was easier to expel the Jewish community and cancel the debts than to repay. This happened in England in 1290, in France in 1306, in Spain in 1492, repeatedly across Europe. The system was vicious. Christians needed moneylenders. They used Jewish communities to fulfill that need. Then they punished them for fulfilling it. The church condemned usury, but tolerated it when practiced by non-Christians. It was hypocrisy with a religious justification. But the most sophisticated workaround was the church itself. Monasteries became Europe's first banks. They accepted deposits from nobles and merchants. They made loans to kings and cities. They invested in land and trade. They operated pawn shops. They issued letters of credit. And they did it all under the cover of charity and stewardship. When a monastery lent money, it wasn't usury. It was pastoral care, helping the needy. When they charged fees, it wasn't interest. It was compensation for administrative costs. When they foreclosed on land, it wasn't extraction. It was accepting a donation. The church created an entire vocabulary to disguise banking as theology, and it worked. Monasteries became enormously wealthy. The Cistercians, the Benedictines, the Templars. They operated across Europe as financial institutions while maintaining the image of spiritual purity. The Knights Templar deserve special attention. Founded in 1119 to protect Christian pilgrims in the Holy Land, they became the most sophisticated banking operation in medieval Europe. Here's how it worked. Pilgrims traveling to Jerusalem faced a problem. The journey was dangerous. Carrying gold or silver invited robbery. Many pilgrims were attacked and killed for their money before ever reaching the Holy Land. The Templars solved this. A pilgrim could deposit money at a Templar house in Paris, receive a coded receipt, and withdraw the equivalent amount at a Templar house in Jerusalem. This was the first international banking network. No physical money moved. Just paper. The Templars kept ledgers. They balanced accounts across Europe and the Middle East. They charged fees for the service, not interest, service fees. But the system was banking. The Templars expanded. They lent money to kings. They financed crusades. They managed estates. They invested in trade. They became creditors to nobles across Europe. By the early 1300s, they were so wealthy and powerful that they operated as a state within states, but that power created vulnerability. King Philip Rackzé of France owed the Templars enormous sums, with debts he couldn't repay. In 1307, he accused the Templars of heresy, arrested them, seized their assets, and convinced the Pope to dissolve the order. The charges were fabricated. Confessions were extracted through torture. The real crime was being too powerful and too rich. The Templars were destroyed. Their wealth was confiscated, and Europe lost its most advanced banking network. But the model survived, because by 1307, Italian families had already learned from the Templars. They'd seen how to operate banking under religious cover, and they improved it. The word bank itself comes from this era. Italian moneylenders sat on benches, banco in Italian, in marketplaces. They exchanged currency, accepted deposits, and made loans. When a banker went bankrupt, unable to meet obligations, his bench was broken. Bancarata. Broken bench. Broken bench. That's where we get the word bankrupt. The Medici family in Florence perfected the model. They operated as wool merchants and silk traders officially. But their real business was banking. They used bills of exchange to lend across Europe. They partnered with popes, financing Vatican expenditures. They became the Vatican's bankers, holding deposits, making payments, and transferring funds. The same Vatican that condemned usury. The contradiction was so blatant that in 1478, Pope Sixtus IV borrowed 40,000 florins from the Medici to finance a war. The Medici to finance a war. The loan came with fees, penalties for late payment, and currency exchange profits. It was a loan at interest. But it wasn't called that. It was a partnership, a service, a gift. Anything but usury. The Fugger family in Germany did the same. Financed Habsburg emperors. They financed Habsburg emperors. They funded the election of Charles V as Holy Roman Emperor in 1519, lending 850,000 florins to bribe electors. In return, they received mining rights, trade monopolies, and repayment with interest disguised as territorial revenues. These banking families became richer than kings. They shaped politics. They financed wars. They built churches and funded art. The Renaissance itself was underwritten by banking profits that technically didn't exist because charging interest was still, officially, a mortal sin. Act 4. Who profited? The evidence. 2 minutes. So who actually benefited from this system of theological gymnastics and financial innovation? First, the banking families, the Medicis, the Fuggers, the Lombards, the Bardi, the Peruzzi. These weren't just merchants, they were financial dynasties. They accumulated wealth that lasted centuries. The Medici produced popes and queens. The Fuggers became creditors to empires. They profited from the gap between what the church said and what the economy needed. Second, the church itself. The Vatican operated as both regulator and participant. They condemned usury while borrowing at interest. They collected donations from bankers seeking absolution. They sold indulgences, literally selling forgiveness, which generated revenue that funded cathedrals, armies, and art. The church profited from both the prohibition and the violation. Third, secular rulers. Kings and nobles needed credit to wage wars, build castles, and maintain courts. The usury prohibition didn't stop them from borrowing. It just made them dependent on those who could navigate the loopholes. This gave bankers political power. A king in debt to a banker had to protect that banker's interests. But there were losers. Jewish communities paid the price for Christian hypocrisy. They were allowed to lend because Christians couldn't. And then they were persecuted for doing what the economy required. When debts became inconvenient, expulsion was easier than repayment. The same Christian borrowers who needed Jewish moneylenders resented them for providing the service. Ordinary people lost too. When you're a peasant needing a small loan to buy seed, you don't have access to Medici bills of exchange. You go to a local moneylender, often Jewish, and pay high interest because the risk is high and the loan is small. When you default, you lose your collateral. The sophisticated financial instruments that let wealthy merchants avoid usury charges didn't trickle down. And here's the deeper cost. The prohibition on usury slowed financial development for centuries. Credit markets that could have emerged earlier didn't because of theological constraints. When finally workarounds were found, they were complex, expensive, and accessible only to elites. If the church had simply reformed its position on interest, financial instruments could have been simpler, more transparent, and more broadly, accessible. But reforming would have required admitting error, and institutions don't admit error easily, especially when their authority rests on claims of divine truth. It was easier to maintain the prohibition while quietly enabling violations. This pattern repeats throughout financial history. When rules become economically impossible, they don't get repealed. They get reinterpreted. Loopholes get created. And those who understand the loopholes profit from those who don't. Act 5. The system behind the system, 2 minutes the church's usury prohibition couldn't survive contact with economic reality. But rather than change the rule, the system created mechanisms to bypass it. This reveals something fundamental about how institutions operate. Rules are maintained not because they work, but because changing them is costly. Admitting the usury prohibition was wrong would undermine church authority. If they were wrong about usury, what else might they be wrong about? So instead of reform, you get legal fictions, bills of exchange, loaves of exchange, partnership structures, service fees, all designed to preserve the appearance of compliance while enabling the substance of violation. This required cooperation from elites. Theologians provided the justifications. Bankers provided the mechanisms. Popes provided the protection. Everyone benefited from maintaining the fiction. The only people harmed were those without access to the workarounds, the small borrowers, the outsiders, the Jewish moneylenders who took the blame. The church eventually reformed. In 1515, the Fifth Lateran Council permitted Monte di Pita, pawnshops run by Franciscan monks, to charge interest to cover operational costs. It was a crack in the doctrine. By the 1600s, theologians were openly debating whether moderate interest was acceptable. By the 1800s, the prohibition was effectively dead, but the centuries of prohibition shaped European finance permanently. It drove innovation in financial instruments. It created the legal structures for limited liability partnerships. It forced the development of sophisticated accounting. The workarounds became the foundation of modern banking. Without the usury prohibition, capitalism might have developed differently. Simpler, more transparent, but also less sophisticated. The prohibition forced creativity. And that creativity built the tools that would eventually finance the Industrial Revolution. There's a lesson here about constraint and innovation. Sometimes rules that seem to prevent progress actually force innovation that wouldn't occur otherwise. The church's usury ban didn't stop banking. It made banking more complex, more sophisticated, and ultimately more powerful. But it also embedded hypocrisy into the financial system from the beginning. Banking was born in contradiction, condemned publicly, practiced privately. That pattern persists. Act 6. The modern investigation. 1.5 minutes right now, the same pattern plays out in modern finance. Institutions maintain rules publicly while creating workarounds privately. Central banks claim to fight inflation while creating it through monetary expansion. They condemn speculation while providing liquidity that enables it. They preach market discipline while bailing out failures. Corporations claim to maximize shareholder value while structuring compensation to benefit executives at shareholder expense. They advocate for free markets while lobbying for subsidies and protections. Governments condemn tax avoidance while creating the loopholes that enable it. They pass complex regulations that large firms can navigate but small firms can't. They claim to support competition while protecting incumbents. Protecting incumbents. The pattern is identical to medieval usury prohibition. Maintain the rule. Create exceptions. Ensure that those with resources can access the exceptions. Those without resources face the rules full force. The church said usury was sin, but enabled bankers to charge interest through complex instruments. Modern regulators say certain practices are prohibited, but enable sophisticated actors to achieve the same results through legal structures. The medieval peasant paid high interest to a local moneylender because he couldn't access bills of exchange. The modern small business pays high rates because it can't access the sophisticated financing available to corporations. The Jewish moneylender was persecuted for practicing usury, while Italian bankers were protected for doing the same thing under different names. The modern individual faces penalties for actions that corporations accomplish legally through complex structures. Institutions don't change. They adapt their language. The prohibition remains. The practice continues. The gap between rule and reality creates opportunity, and those who understand the gap profit from those who don't. The verdict: 1 minute. So what does this mean for you? First, understand that financial innovation often emerges from constraint, not freedom. The most sophisticated financial instruments were created to bypass religious prohibitions. When rules become economically impossible, workarounds appear. Those workarounds often become more powerful than the original activity would have been. Second, recognize that institutions rarely admit error. When church doctrine conflicted with economic need, doctrine didn't change formally, it got reinterpreted. Modern institutions do the same. When regulations conflict with institutional interests, regulations don't get repealed. They get exempted, reinterpreted, or selectively enforced. Third, this affects you directly. Financial systems are built on these historical contradictions. Banking emerged from religious prohibition. Modern finance inherits that legacy. The complexity, the loopholes, the gap between appearance and reality, all of it traces back to the church's refusal to simply say, "We were wrong about usury." The Catholic Church didn't invent banking, despite condemning usury. They invented banking because they condemned usury. The prohibition created the need for workarounds. The workarounds became the system, and the system built capitalism. Now you understand the mechanism. Now you see the pattern. Institutions maintain rules that serve their authority while creating exceptions that serve their interests. It happened 800 years ago. It's happening now. What you do with that knowledge is up to you. If this investigation changed how you see institutions, subscribe. There are more cases to solve. More contradictions to expose. More systems hiding in plain sight. This is the Financial Detective, and the investigation continues.